Imagine the perfect income stock, a 5-year track record of ascending dividend payouts, supported by rising revenue. The payout ratio looks safe. The yield hits your target. By every metric, it passes the test. Then, the board slashes the dividend. The stock price craters. You followed the playbook exactly. You didn't chase an artificially high yield. You monitored the payout ratio and verified historical reliability. Yet you were caught holding the bag because of a structural crack you couldn't see. The issue is that traditional income screening operates as a history strategy. It focuses exclusively on outputs, the payments a company made in the past. It ignores the actual inputs required to fund those payments in the future. Predicting whether a dividend will even exist in 4 years requires tracking the single metric that proves a business is generating sustainable cash. That metric is the free cash flow margin trend. Free cash flow margin is the actual cash left over after all operating costs and capital requirements are met, expressed strictly as a percentage of revenue. This shows top-line revenue passing through cost filters, leaving only pure distributable cash. Most investors who encounter this metric make a specific error. They only evaluate its current absolute level. But measuring the level at an isolated point in time obscures the actual health of the business. Look at this 8-quarter grid. A 20% margin slowly declining for 6 straight quarters is highly dangerous. It hides a looming payout ratio problem. Conversely, a lower 12% margin steadily climbing is actively building capacity for future dividend growth. The foundational rule for income analysis is this: the current margin level only tells you where you are right now. The margin trend tells you exactly where your payout is going next. Dividend cuts decay through a predictable 3-phase sequence. In Phase 1, the illusion, revenue grows through new products or expansion. However, these ventures require more capital. The revenue bars rise, but the margin line overlay stays completely flat or dips slightly. This creates a dangerous illusion of safety. Because top-line revenue is up, the absolute amount of cash flowing into the business is still technically growing. To the untrained eye, the dividend is secure. Then comes Phase 2, the squeeze. Input costs spike or competitors force prices down, and margin compression accelerates. The flat margin line begins sloping steeply downward, dragging absolute cash flow down with it. The company spends more to generate every dollar. To conceal this internal decay, corporate boards deploy a predictable tactic. They allow the payout ratio to expand so they can keep raising the dividend. On paper, it looks like a disciplined commitment to shareholders. In reality, it is a glaring warning sign. This leads directly to Phase 3, the breaking point. The payout ratio expands until it hits a hard mathematical ceiling. The company has zero financial flexibility left. The trap is now fully set. The next minor economic headwind or supply chain disruption eliminates whatever thin headroom remains, leaving the board with no option but to force a severe and immediate cut to the payout. Traditional income investors experience this as a random, unpredictable shock. But the margin data had been loudly announcing the structural decay for 6 to 8 quarters beforehand. If you rely solely on historical yields and payout ratios, without auditing the underlying structural efficiency of the business, you practically guarantee that you will eventually hold a position when the math breaks. We stop diagnosing the failure after the fact, and we start running a strict protocol to catch it beforehand. Calculation 1 is the 8-quarter margin trend, mapping 2 years of data to spot acceleration. Calculation 2, margin-adjusted capacity, calculates the sustainable dividend growth rate. Calculation 3, the stress test, projects compression forward to reveal precisely when the payout breaks. You do not need Wall Street insider access to run this diagnostic. The numbers required for all 3 calculations are publicly available in every standard 10Q quarterly earnings filing. A growing income stream is one of the most powerful total return mechanisms in equity investing, but it only survives if the business actually generates the underlying cash to fund it. Stop assuming the future will look like the past just because the streak is intact. Use these 3 diagnostics to stress test the underlying mechanics and start actively pricing the future of your portfolio.